Hi there, Internet. Today I wanted to give an update on one of my favorite underdogs, a company called Xiaomi or Zepp, depending on where you live in the world. So let's take a look at the company and what I think the future prospects might be. So my longer term followers will know that I am a big fan of this company. I think it's incredibly undervalued. But it has had a tough quarter or so. So, I mean, it's had a pretty good recent run. But if we look at the stock price from the highs back in end of February, we can see that it's dropped. It's lost 59%, up to 60% of its stock price through the last few months. In part, this was because of the wider sell-off and subsequent bearish market in Chinese technology businesses. But we can see now that it's also followed the recovery, the bounce that we've seen in Chinese tech. And if you'd managed to pick it up around $8 at the low, it's now appreciated by nearly 55%. Looking at the company, so it is still called Xiaomi inside of China, but it has been rebranded as Zepp outside of China. So if we look at the profile of the company, some of this data is slightly out of date, but it is one of the largest wearable device companies in the world. These numbers, I think, are incorrect. They are all higher now. The CEO is a man that's been involved in the industry for some time. He's well known in the industry and has led software and hardware teams. He's what they call a serial entrepreneur. Now, any conversation around Xiaomi needs to go hand in hand with Xiaomi. So for those that don't know, Xiaomi is the third largest mobile vendor in the world. They've been growing rapidly in recent years. And so they are third just behind Samsung and Apple. So initially, at least, the markets that Xiaomi served were more or less the same markets as Xiaomi. And this is because Xiaomi was effectively the fitness wearables company, manufacturer for Xiaomi. That's how Xiaomi was making all of its revenue, at least initially. And so that's a good way to get a leg up, is to piggyback off the success of another large company, but then that obviously becomes an enormous risk for your company because you want to diversify your revenue streams. We can see, I'm looking at this little table here, the 100% reliance on Xiaomi in recent years has been decreasing. So through 2019 and 2020, Xiaomi still accounted for roughly 2/3 or more than 2/3 of their revenue, and their self-branded products have been a quarter, nearly 1/3 of the revenue stream. The CEO and CFO have reiterated through earnings calls and other kinds of interviews through this year that they think that they should see the split being more 50-50. So that will be quite a milestone for them and quite a lot of growth in terms of their self-branded products. And their recent earnings, you'll see enormous growth in their sales of self-branded products. It's in their best interests to promote these for various reasons, including that these are lower margin products, meaning more profit for them. Now, in terms of ownership of the business, particularly for younger businesses, I like to see a lot of insider ownership. What is interesting beyond the relationship between Xiaomi and Xiaomi, which is more than just strategic, so it is contractual, is that Xiaomi as a company, at least in 2018, I haven't been able to find very recent numbers, but in 2018, Xiaomi owned 19-20% of Xiaomi, and the CEO of Xiaomi owned that same amount on top of the 20% that Xiaomi owns. So each of them owning 20% and cumulatively 40% of the business mean that they've got more than a vested interest in the success of this business. I do believe that those percentages have decreased through various investment rounds as the initial shareholders would have been diluted. But what is also interesting is that there is a large portion of insider ownership of the business. And this is good because especially when a company is young and is trying to find its feet and grow rapidly, you want the people that are operating that business to have an aligned interest with the success of that business. It's very hard to get a young company off the ground. All odds are against you. So the people that are running the business need to, they're going to have to put out all kinds of fire and fight all kinds of battles. And it's a grueling, grueling task. So if their financial interests are aligned with the business interest, that's fantastic, particularly in the long term. What is also interesting is how fast the wearables market is growing. So I think this was published in 2020, but the forecast is that by 2025, the number of devices will be, I think, more than double what they were in 2019. So over 6 years, the size of this market doubling, which is fantastic for anyone that's involved and is successful in that market. So it's a good growth market. What's quite interesting is that Zepp is looking beyond just this market, but this is a good sign. They've done well so far, and I'll talk about how much of the market they've been able to capture recently. Now, I've spoken interchangeably about Zepp and Huami. I mentioned that Huami is the original name for the company, and that's the name within China. The name is Chinese, and in 2018, Huami acquired a company called Zepp that is US based, so based in California, and they had their own. They were working on their own wearables at the time, and the reason for the acquisition of this company is strategic, just beyond the things that they were working on, the assets that they had in terms of intellectual property. Zepp wants to be a global player. They are a global player today, but they've recognized the risks to their company in being a Chinese brand trying to sell into the West, which is a very large and wealthy component of the world population. By acquiring Zepp, they changed the perception of their brand from being Chinese by giving it a more Western-friendly name. They also now have an office in the US, and in appearing to be slightly more Western, they're hoping that this makes them a bit more appealing to that market. On top of this, they used this acquisition as an opportunity to say that they're no longer just a technology wearables company, but in fact are a digital health company. And although the difference is subtle, it is important. It gives them a much broader market to eventually sell into. What is also quite interesting is the fact that they have fairly recently completed replatforming on AWS. By being on AWS, a platform that is owned by an American company, this means that the American government and regulators and legislators are potentially not going to be as negative about the company. All right, so that's the company overview. Let's take a look at the products that they have currently and what's coming up in the pipeline. So their main product historically, and more or less up until recent history, has been Xiaomi's Mi Band. So the most recent relaunch, the Mi Smart Band 6, happened just a few months ago, and the upgrade cycle is part of what has held back their revenues and their profits for this year. So people that own the Mi Band 4 or the Mi Band 5 or some older version have been waiting, anticipating this launch, and so not buying it. I'm quite interested in seeing the earnings report for Zepp this quarter, because these sales will now be in those numbers. And the CEO has said that sales have been looking very, very good for the Mi Band 6. The Mi Band, in a nutshell, is kind of a smartwatch with a much lower price point than you would see for Apple's watch. So £32 versus several £100s. And the device is incredible. I cannot believe the capabilities that they have managed to fit into this little device. And part of this is because Zepp is got very strong technical know-how. They've developed a lot of their own hardware, including an AI chip that I'll talk about in a moment. So you can read about some of the capabilities of this device. The list is very long. I think that almost all, and maybe all, of the capabilities that you find in the Apple Watch are available in this device at this price point. It's absolutely mind-blowing. So you can see that the reviews on Amazon, and I've checked in other places, are fantastic, and it's #1 seller on Amazon. So this is, as a reminder, the product that they build for Xiaomi. It's not their own branded product, it's the product that they build for that big mobile maker. But obviously they're able to stand on the shoulders of giants because Xiaomi gives them access to a much bigger market than they would have access to otherwise. Now, what Zepp had done is start building out their own devices so that they can reduce their reliance on Xiaomi. And they've got a range of wearable devices, this is where they started, that appeal to different demographics through price point, but also you can see that this is a bit more of a rugged watch for whoever wants to be a bit more rugged. In addition to this, they have recently been expanding out to other types of products. So there are the smartwatches, which have been selling very, very well. I know that this T-Rex Pro the sales have been through the roof. And on top of this, they have got things such as home studios, a treadmill, as well as their own clothing lines, etc. So this is the brand that they had created initially, and reviews are good, and sales are good, and growth in sales are enormous if you look at their most recent earnings report. On top of their own branded products, you can see this is the Zepp line of products. These are just smartwatches appealing to the higher end of the market. The marketing is fantastic. The devices look good. They look very similar to some of the competitors' products, as you may have noticed. What I don't like, though, is that it's a little bit confusing having two brands that have very, very similar products. So I am hoping and wondering if they will collapse one of these brands into the other as time goes on. I think that they need to do that. Otherwise, it's confusing to the market. Which one do I buy? People don't understand that they're actually from the same company, etc. So I'll be watching out for that. It's not atypical for a company that acquires another one to keep its brand for a while, even if there is a large amount of overlap. But usually you would want to see them consolidate those brands into one, unless they've got very different products or they appeal to different demographics, which these don't really do. What I wanted to point out here, this is a very recent article from the 2nd of June, is that Zepp is for the first time in the top 4 for wearables by shipment numbers across the entire world in 2021. This is massive. So you need to know where they started. So before this, they were in the top 5. Now they're in the top 4. So they are growing rapidly. Through 2020, there were several challenges to the business. Obviously, there were disrupted supply chains, but also they sell a large number of their products in physical stores. So if you look at the numbers, and we will eventually, you'll see that 2020 wasn't a great year for them. And 2021 was also a little bit slow. But as I mentioned, I think at least in part, that was affected by the upgrade cycle of the Mi Band 6. I encourage you to read any of the press releases that you can, but this line was very interesting to me. So Brazil, Russia, and Spain are the countries where Zepp's self-branded products, so these will be the Amazfit products, ranked first with 40, 41, 29, and 23.5% of the market share for the first quarter. This company is growing fast. They have had hiccups historically. I think those were more down to the situation than the company's capability to operate and deliver. And now that the world is opening up and they've been able to pivot their business a little bit from their over-reliance on Xiaomi to self-branded products, the results are starting to land. Now, in addition to the wearable products, which most people know the company for, Zepp is obviously generating a huge amount of data across its user base. So it has 100 million users across 70 countries. And all of these apps run apps, and those apps are backed by servers and are generating enormous amounts of data. So Zepp has AI algorithm capabilities. They also have their own proprietary AI chip that runs in a number of these devices. And they are collecting this data. And that is part of where the company wants to be eventually in the near-term future. What few people realize is that Zepp owns this company, Pi Health. You might have seen these type of companies in your local geographies. And they are the types of companies that connect the collection of data sources from smart devices or platforms and help plug them into insurance companies so that they can monitor the health of the people that they're insuring and hopefully bring down premiums for those people that are healthy. If you're healthy, you probably don't need to pay as higher premiums because you're going to get sick less often, usually. So you really have to root around in the data to figure this out. Let me zoom in a little bit. But Pi Health is a wholly owned independent subsidiary of Zepp. This happened a few years ago. It's quite hard to find information about Zepp. You really need to rummage around. I know that this is seeking alpha, so this information is very easy to find. But I tried to listen to all the interviews with the CEO, and if you don't listen to them and you just read these articles, you don't have enough context to really interpret what's going on. So here you can see Zepp has partnered with a company, and they are a company that has a portable X-ray system. And you might be able to infer where they're going with this, but the details aren't obvious. And similarly, you see on Seeking Alpha another article talking about a partnership with a company that has pioneer in MRI technology. So my deep investigations have also uncovered the fact that Zepp is trying to get into imaging health technology. So it's starting with X-rays and MRIs, but effectively they are working with these companies to do a number of different things. Zepp has hardware skills that they've developed through creating their wearable technology. They also have proprietary artificial intelligence software as well as hardware capabilities. And now they are looking to partner with these types of companies, acquire parts of these companies, make investments in these businesses and help them expand beyond just the obvious, which is providing X-ray or MRI capabilities, but using data to enrich the outcomes that the patient might experience. So yet another area. This is a bit more experimental, and they've said that they think they'll only start seeing meaningful revenues from this probably next year, but definitely an interesting area and one to watch. And then finally, I've mentioned the AI chips and proprietary technology that Zepp owns. They are potentially looking at licensing that out to other companies, not their competitors, obviously, but other companies that might make use of those capabilities. What about the competition? So Apple is the undisputed champion in this area. But they are focusing on the higher end of the market. And so here, this is a European table. By the way, this is fairly recent. That's today. And you can see that these are the major players. Xiaomi, in part, of course, will be selling Huami products. And Huami is, at least in Europe, in fifth position. But if you look at the year-on-year growth, there is one outstanding winner, and that is Huami. Huami doesn't need to own the entire market to be successful. The market is growing, so everyone operating in the market can also continue to grow. But if they are growing faster than their competitors, that is also fantastic because they will be taking a larger and larger chunk out of the market for themselves. Another key thing to note about their target markets is that Huami or Zepp will have a bigger appeal in emerging markets. Apple products are very expensive. They're expensive even if you live in a developed nation. So countries such as those in Africa or South America or Asia will have a larger tendency towards products that Huami creates. So although I think Zepp's initial target market were those emerging markets because they were obviously leaning on Xiaomi quite heavily, they are in a prime position to service those emerging markets. But now with their higher end products, I believe that they will start growing in the developed nations too. All right, now let's take a look at those numbers, the all important numbers. So revenue growth is showing the right, is going up and to the right, which is fantastic. Their growth, by the way, revenue growth, you can't see it from here, it's not obvious, but revenue growth in through last year was disappointing. It wasn't anywhere near where it was expected. And if we look at profits, we can see that there has been a big hiccup through 2020. This was for various reasons. Some of them I mentioned previously. Increased costs of shipping were one. They didn't sell as much stuff as they had anticipated. Lockdowns were hard on particularly those smaller companies that are involved in hardware and new technology. Despite this, though, I'm looking at my numbers. The 5-year compound annual growth rate of revenue is 48%, which is fantastic. And the 3-year compound annual growth rate of EPS is just about the same, slightly lower than 48%, I believe. So the company has grown like gangbusters. They had a tough year last year, but through this year and looking forwards, not only are their products securing a large part of the market, they are growing into other sectors using what they have, the data and expertise that they have, to grow into other product lines. These numbers become quite interesting. So the market cap is $744 million. The trailing 12 months revenue for the company is $990 million. So immediately we can see that the revenue for this company is larger than the market cap, despite this company growing at a crazy clip. The PE ratio looking backwards isn't so great, and that's because of the profitability hiccup that we saw through last year. But if we look at the forward numbers, which I don't have on here, but I do have them in my notes. So the forward PE is 8.3, which is ridiculously tiny, and the PEG is 0.2. The forward PEG is 0.2, meaning that their earnings growth is massively outstripping their PE. Their operating cash flow yield, again, I don't have that on screen, is roughly 5%, which means that they've got more, they're generating cash and have cash to play with in terms of being able to operate the business. Their net debt is, they have no net debt. The current ratio, though, is about 1.5, which is getting to the point at which you might look at it in a bit more detail. And in terms of the forecasts for, first, let's take a look at EPS. You can see EPS forecasts are enormous, and through 2022, EPS is expected to be up 126% from 2020 levels, and revenue is expected to be up 39% from 2020 levels. In terms of risks, I've touched on a few of them already. So they have a major reliance on Xiaomi for revenue. They're looking to reduce that reliance massively. They also are a little bit of a slave to the whims of the consumer market. So the consumer market is cyclical. People tend to buy more stuff in the second half of the year. So that's when they generally make most of their money. They're looking to decouple from that by creating the data products that I spoke about, but also by getting more involved in the industrial health tech sector. The relations between the West and China haven't been great just about ever, but there's been a little bit of a deterioration recently. And Zepp is certainly aware of this, and I mentioned some of the measures that they've taken to mitigate those risks. Competition will always be a challenge, particularly when you have the likes of Apple and Samsung playing in the same sector as you. They're both mighty companies, run very well with a lot of money. But through the decades, we've seen smaller, nimbler companies grow quite rapidly and take fairly chunky, enormous market share from these giants. I suspect Zepp is an acquisition target, and the most obvious candidate here would be Xiaomi, since they already own a large chunk of the company. And a lot of people have highlighted, particularly in my last update, this strange headline item where Xiaomi acquired a fairly large chunk, although it's called minority in this case, that's a technical term, in this business. And people couldn't understand why this might be. And that is because this company is in a completely different sector. So they seem to mostly work with these types of products. I did listen to a call where someone asked the question of the CEO and the CFO, and they've said that they are waiting for the Chinese regulator to approve the deal. But in the meantime, what they have been able to say is that this will help them sell their proprietary technologies that they've created, their hardware technologies like their chips. So I eagerly await more details, because that is basically all that I know about this acquisition. They've spent a lot of money on it, and they've acquired a fairly chunky part of this business. I hope this doesn't signal anything dodgy, but this is one of the major risks that I'm looking out for, because the other risks they've more or less mitigated, and I've mitigated risk by keeping my investment in this company at a few percent. In conclusion, I would say that Zepp Health, the price action has been frustrating. It's not just down to the business, though. It is also down to the wider Chinese technology market. To me, the company was cheap before the massive sell-off even happened, and so has become cheaper yet through that sell-off. The company knows what it's doing. It is trying to do a lot of different things at once, which is a little bit concerning to me. So they are showing great success in the wearables market, but they're trying to break into these other areas. I think that the data products that they're developing are strongly aligned to what they're already doing, but the industrial health tech side, although it's adjacent to what they're doing, it's not directly in their wheelhouse. So I hope that they're not spreading themselves a little too thin. However, looking at the competitive landscape, the company is growing fast. They're acquiring market share quickly. Recent data shows that people love what they're selling. They're working in a growing market. Their books are really good. They had a shitty year in 2020, and the first quarter of this year was a little bit soft, but things are starting to look up for them. So for me, Zepp is a buy, but because of the risks surrounding it, I would keep the portion of it that I hold in my portfolio fairly small, just until we have a few more details and a bit more information about recent performance in the market. All right, that's about it for Zepp Health. I hope you have a great week. Bye.